Just after 10:30 in Honolulu, 4:30 in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 17th day of January 2014, and this is the daily report for gold and silver, our weekend review. Nice little rally as we go into the close of the week. We have the precious metals pretty much across the board trading higher. The Dow Jones is trading higher. The dollar index is trading higher, and crude oil is trading higher. Let's get to the board. First, we are currently trading at $1251.42, puts it up roughly $8.50 on the day. It's had a low of $37.20 and a high of $56.20, so about $5 off the highs, and you can see some of the highs right in here on the 60-minute chart. Silver right now is trading up about 19 cents on the day, $20.25 with a low of $19.90 and a high of $20.53. Well, traders, once again, we are up against what I like to call a crossroad. We've got real resistance at about 1253 to 1255. I'm going to show it to you on a couple of different charts. This, of course, is our 60-minute chart, our hourly chart, standard candlestick format. When we look at this most recent top, and this, of course, happened back on the 13th, we look at today's top through this chart. No doubt right now, at least for now, we absolutely have a double top. But more importantly than that, when we look at it through a couple of different charts, you're going to see a multiple amount of indicators showing us that we're at the crossroads. Now, this is yet another way to look at the same information, 240-minute chart, also standard candlestick format. Let me blow that up and line this up. And what we're looking at right here is what we call Fibonacci harmonics. And with Fibonacci harmonics, what we do is we compare different Fib retracements with different time sequences as well as price sequences. You can see we have a short one from 1252 to 1227. We also have our longest one on this particular study is 1300 down to the 1185 area. We then have another one which matches this bottom here at 1227 from the top. And then I believe we have one last one which starts at 1300, moves down. And so what I look for when we do this is basically I'm looking to see which particular areas have harmonics or multiple readouts, because here 1227 is a 38% retracement, but it's also a 23% retracement of this shorter move. Now, on this particular one, we have even more than that because we have this 23%. We also have 1228 as a 38%, and that 38%, as you can see, is basically this move right here. So when we look at them all together, what we do is in points in which we have multiple indicators, and the strongest one right now is 1227, 1228. You get three different matches on just this one. You also get one at 1238. It's a double match. But here's what we're looking at. In terms of where we are looking for this market to head to, you can see the double top right in here. But it's actually more important than that. And to show you what I mean, we need to pull up another chart. We're looking at our 700 or half a day chart. And here again, you can see this area of 1253. This is the double top that we talked about right in here, very, very short term, of course. And then if you look at recent activity, this is back in November of last year. You could see quite eloquently that it was absolutely an area of resistance. Here it was able to exceed or move above that resistance, just formed a little bit of a top and then came back down. And of course, we have very, very strong support, I believe, right now at, call it 1185. But to me, the most important resistance area or crossroads, and this is the reason I'm calling it a crossroad, it's a pivotal point, is when we look at our daily or two-day chart. That's what we have here. This has our basic Elliott wave count. But more importantly, we have a resistance line. And this resistance line is simply created from the tact or the angle of these tops. You look and boom, when the market came up, that one large rally we had last year, it stalled right there. Secondary rally, it stalled right there. And this current rally, it is right there. Now, when we go and blow it up, you'll see really how close we are. We're very, very close, and let's go ahead and do that. This is that resistance line. We've gone ahead, we've blown it up, and you can see right now that we are very, very close to the point in which if the market continues higher, it will absolutely break out, and a breakout above this point, this pivotal point, to me signals some really, really bullish days ahead. However, if in fact what we see is the market come up and stall here, as it did in this occasion, as it did here, then what I'm looking for is the final completion or leg for this fifth wave. It could end up being a truncated fifth, or it could go below. If we stall in this area, I think that at least we'll see it retest 1227 and 1221 and possibly 1211. The point is this is a critical area, because a break above this would signal that for the first time since this market has hit these record highs, that was at 1920, then it stalls and we have this triple top at 1800 right here. But since this triple top, the market has done really one major direction, and that's been down. As I said, aside from this one rally here off of these tops, and now we've got this secondary rally, or the first rally of this year. We had one other point in which it came up, and on each occasion it stalled right in this area prior to this. So the question is, will gold have the kind of momentum that's really needed to break above this particular intersection? Traders, we are short the market. We're short at 1245. I was hoping to see the market break down. We saw it trade a little bit lower. It's firmed up dramatically today. When we look at our two-day candle, it is very, very doji-like, and that's a two-day candle. When we convert it to a daily chart, let's go ahead and do that now. You can see that it looks a little bit different because you had that doji really yesterday, and today we've got this solid up move. But we've had higher closes for the last 1, 2, 3, 4 days. And when we convert this to the Japanese average, although we have that tremendous up day, traders, here's what we see. Because realize, the difference between the Japanese average and straight candlesticks is how they create the open and close, or the body of the candle. On the average, you're comparing it to the midpoint. So whereas you saw that nice size up candle in a standard candlestick chart, what we're seeing here is, of course, it's still green on our daily charts, but look at the body size. First of all, we have a return of tails, and what that tells us is that it trades above and below the midpoint. And we've talked about this on many occasions, that when you get to various tops or bottoms in the market and you get that kind of color change, changing of the guard, so to speak, typically you'll get a smaller body size prior to that happening, very, very doji-like, and then it will change colors. So you are in a scenario where we've got basically one of two ways we'll look at it through the Japanese average. Look at this basic ascent in the market. The market moves up solidly, but trades a little bit sideways for a day and then begins to move up again. Now we've got this small body candle coming in. In the same way, let's look at this. This is one nice rally, but you have the markets come up and you get this area of breathing. You see, you've got the same body size in terms of the fact that it's got a tail again, and the fact that the body size has shrunk. But in this particular instance, it was just a point at a breather until it returned in that upward direction. So just because we see the smaller body size, we really need to see it go red before we can say we have a transition. But what we can say right now is we have qualified really good support, double bottom 1186. And we have also seen, at least for right now, some real resistance right at around 1253 to 1255. You can see it's not been able to overtake these tops, and so we'll have to see how it plays out. But I can tell you that the fact that the body size is getting smaller, even in line of this nice up day, doesn't tell me that we've got this absolute breakout to the upside. I believe that we need the technical evidence, meaning we have to cross above this intersection before I really get bullish, because if it simply hits this line and backs off, we're really going to be seeing more of the same that we saw here and that we saw here. And so when we look at the straight candlestick charts, we've had series of higher highs, we've had series of higher lows, but we have not made it above long-term resistance yet. Now, although we have not broken above that long-term resistance line, what I've done on this particular chart is I've put up a Andrews pitchfork. The Andrews pitchfork itself we've used before, but in terms of the handle, we peg it from this high, this low, and these are 3 data points, and then this high. And then that, of course, gives us our pitchfork center handle, or 50% right here. Now, what I look at when I look at this is in a defined uptrend or downtrend, and let me go ahead and blow this up. What I want to see is whether or not it is breaking through certain levels or trading in certain levels, meaning channels. Here you can see it moves, it breaks across all the channels, but here it actually begins to trade within the channel. You can see this breaks to a lower channel. And so that's significant to me. Here it breaks to the higher channel, but it finds resistance at the top of this channel. Here we're finding support at the bottom of this channel, and that's why I'm pulling this chart up. We are above this particular channel here, and in terms of bullish sentiment, that does indicate, at least temporarily, we want to see, will it be similar to this area where it pops above and then goes below, or will it continue to break higher? If in fact we see that market break above the intersection, we would begin to see it break through these various channels. And when you compress it, and the way I do that obviously is we're pulling up a weekly chart. This weekly chart, of course, continuous contract of COMEX gold. And it's quite easy to see when we look at it how this resistance line has absolutely held. And you can really see how these last 2 points the market comes up to try to break through, goes right to the line, and then begins to trade lower. Same with this, then begins to trade lower. So the question is, as we get close to this crossroads, will it then come down again, or will we get a break above? Historically speaking, we've got to break above that before we can be bullish in any long-term way, because that's a long-standing resistance line that really started at the end, or the last quarter of, I should say, 2012, and it is really the last time we saw gold trade at around 1,800 per ounce. The other thing that's noteworthy on this chart before we move on to silver is the fact that when we look at the long fib retracement, and this long fib retracement's below 700, above 1900, the fact that we've got this particular point, which is 1161, has held, and the fact that that is a 61% retracement of this large move, there is actually a case that can be made for a major count, this being one major wave here, and this would actually be our M1, our major one. And the reason that that is possible and more likely than an M3 is that typically your major 2 is where you get this big retracement that will go to 61%. You typically get a 38% retracement in a fourth wave. So with that in mind, and looking at this chart just from a glance, just in this area, you have major 1, this is major 2. Let's say that it's been truncated and it's complete, okay? Then we would actually have a major third wave that would take off. Now, nothing can be ascertained from this particular count unless this market breaks above this particular resistance line here. Now, when you consider the charts that we were just looking at in gold, in which we've seen a definitive rally coming off of a point of 1186, moving up $100, roughly a little bit shy of $100 now that it's at 1250. And then we look at silver. There's no doubt silver has just been in this defined range right in here. I'm going to not include all of these tops, but as you can see, when we look at this market, without a question of a doubt, has been in a pretty tight trading range. It is not trading in the same typical way that gold has been trading, because when we see that, we get declines, strong declines in gold, strong declines in silver, and the reciprocal. During a bullish rally, of course, you get the bullish rally in gold and in silver. Now, you're getting these rallies, there's no doubt, but it still defines within this range in which it's been hitting the top and the bottom of the cycle, and you're looking at about 1250 on the top, call it 19 on the bottom. So you've got from 2050 or so, you've got roughly a dollar and a quarter range on it. And more importantly, it's staying in a defined range rather than a unified direction such as we see in this rally or this sell-off. We're going to be maintaining our short position in gold through the weekend. We'll see how it reacts. Of course, on Monday, the markets are closed for Martin Luther King Day here in the States. So we will talk to you on Tuesday for another daily update and review. Should there be any activity that warrants your attention, we will send you out either a special trade alert, special trade notification, or create a special video to highlight the information we're trying to present. This has been Gary Wagner wishing you as always good trading, and we'll talk to you next week for another daily update and review. Bye-bye.